So fundraising, and this presentation was done in true lean startup mode. It was literally just in time, and this is a minimally viable presentation. Minimally viable presentation. And I prevented myself from developing a fully thorough presentation just to show you the skills of lean development. And so I'll be relying upon you and feedback, and we'll iterate this as we go. So fundraising's really this fantastic art of where you guys, the missionaries, meet the mercenaries of the VCs, and hopefully you realize that you're each one and the same. You're both missionaries and you're both mercenaries. But there's a dialogue that has to happen for that to occur. There is no agenda slide. Before I begin, actually, I just want to tell you guys about who I am. And I don't know if you guys know what my background is, and I should have probably done this earlier. But so I formerly spent 6 years at Draper Fisher Jurvetson, which is one of the largest venture capital funds in California, and one of the premier venture capital funds. They were started in 1985. Draper Fisher Jurvetson manages over, I think it's $5 billion now of capital under management. And I worked there from 2002 through 2010 and took 2 years off to go to Harvard Business School and then returned. And served on 5 boards and was an observer on probably another 5. And probably was involved either as the analyst supporting or as the prime VC about 15 different companies, and including doing recapitalizations and all of these things. So that's sort of my background. And then before that, I was at 2 Kleiner Perkins startups, one as an intern as a Mayfield Fellow, and the other as a product manager. And then I was also at McKinsey for a little bit too. But that's sort of my background. So I've seen this world of fundraising pitches probably more than I don't know what competence I have in life, but to the extent that I have a relative strength, it's probably having seen a bunch of fundraising pitches. So I'm going to share with you my philosophy on fundraising, and then I'm also going to walk through the more technical aspects of term sheets. The first thing to do is to go, and I think a classic example of a pitch is the Mint seed pitch, which is on SlideShare. How many people saw that? Okay. It's fantastic. So if you haven't seen that, as a basis point, that's a place to start. Okay? And the thing to think about whenever you do a pitch, there's a whole bunch of material online about what you need to include in a pitch. But here are the basics. And these are the basics that you'll see across a whole bunch of different sources. What I tried to do here, though, was rank order what's important from stage. So when you start out, when you're doing your seed round or your Series A round, the most important, you're fundraising off of the potential of your idea. And this is a critical concept to try to bake in, is that you can raise money either off of the idea or the results. Okay? And sometimes it's more advantageous not to have results, because the idea can be more romantic than the actual details of the execution. And the beautiful thing, the advantage of not having any results or any traction is that there's nothing that you've screwed up yet. Okay, so you guys, when you're raising your Series Seed or your Series A, have the advantage of not having had a lot of rope. So there's nothing that I can hold you accountable to. And so what really becomes critical then for when VCs are evaluating you at that level are the permanent aspects of the business, which include typically the team and the market, the general market that you're going after. How you attack that market's going to change, and you're going to constantly pivot. But if the market's big enough and the team is compelling, those are probably, for the bulk of investors, those are the 2 most important things when you're raising your Series Seed. Now, in this day and age of lean development, the immediate thing that people are going to want to see after that is some type of example of product or a demo, and you're going to want to show some traction as well, and we're going to get into that. But the deck itself should include these basic elements, but the most important elements to think about are the team and the market. And if I don't cover it, I will cover it later about thinking more about the nuance between raising off of the potential and the idea. But that's just the quick thing to start. Yeah?
Will you have these slides?
So the question is, will I have these slides? maybe it depends on what you guys, the feedback you give me. They're really basic, okay? But yes, I'll try to put up these slides. And for special students, I'll just email you the deck. Okay. So I'm going to tell you about some things that I don't think, I'm going to really focus on the things that I don't think get emphasized enough. And there's a lot of stuff that I'm not going to hit that's also important. So the first thing to think about is that the fund size that you pitch should mirror the exit outcome that you expect. Okay? And what I mean by that is that to the extent that you're trying to align incentives between you and your VC, if you think about most venture capital funds have, in general, they have what they're thinking about when they're evaluating you is they have to pay back their fund. Okay? And their big time constraint, or their biggest bottleneck, their biggest constraint is typically time. So most VCs have the mandate that they have to serve on the boards, or at least be literate of what their companies do. And that constrains how many companies they can be involved with. And they also have the mandate where they're going to try to return a third of the fund with each investment that they make. So when they're looking at you, if they're investing out of a $600 million fund, they're realistically going to be trying to think that they're going to want to return at least $200 million back to the fund to make their time worthwhile. It's not a question of whether or not your business is a good business or a bad business. It's just the fact that they can only serve on a certain number of boards a year. And if they have to return $600 million back to the fund, just given probabilities, they want their investment to return at least $200 million back to the fund if it's a $600 million fund. And typically, a VC would be lucky if they own 20% of a business at liquidity. So if you do the math and you pitch a $600 million fund, you have to have an exit outcome of being worth about $1 billion for it to be a meaningful return for that GP. Now, if you think about what that GP is sitting at too, that general partner, their fund doesn't make any money unless the whole fund returns the principal value of the fund, right? So if I'm in a $600 million fund, for me to even think about getting any profit back, I have to have $3 billion companies, right? And hopefully own 20% of each of them. And then I just pay back the fund. And then it's the incremental one where I start pulling down carry. So even if I, as a GP, have all three of my companies succeed as billion-dollar companies, I can't get any guarantee if my partners don't also have billion-dollar hits in their funds. And so what that creates then is that if you're not a business that's aimed to be a billion-dollar business, the venture capitalist is far more incented in a big fund to push to an outcome where there's even a small probability of a billion-dollar exit, even if there's a large probability of failure. They would much rather have a 5% chance of $1 billion and a 95% chance of zero than a 50% chance of $50 million. Because a $50 million exit is a $10 million return back to a $600 million fund, which is trivial. They might as well not have wasted their time. And it's nothing personal. It's just a function of the way the economics work. Now, if you pitch a $100 million fund, if they get a $30 million exit back to $30 million check back to their fund, they'd be happy. And that would typically happen, if you have a $150 million exit. And then if you pitch a $20 million fund, similarly, if they have a $7 million exit back to their fund, they're happy. And which is aligned if your exit outcome is expected to be $20 million, and that's aligned with the fund size, then your incentives are aligned with the board member, if that's what you want. So in many ways, this isn't a question of what's good or what's bad. It's just a question of understanding who you are and having your best self come out by aligning yourself with the partners who will want to make that happen. And if you so the first thing that I don't think gets emphasized enough is that you should really be pitching a mix of VCs to figure this out, because it's oftentimes easiest in that process to understand where the fit is best. And you're going to be naturally, you're going to get more traction with the VCs where there's more alignment. So you might have a perfectly fantastic business, but your business is going to make you ridiculously wealthy at a $50 million exit, and the VC is not going to give you the time of day because it's just not a big enough market for them. So understand that it's not personal, but you want to think about the right fit. Okay? Does that make sense? All right. Okay. So now I'm going to, yeah.
Why would you need to talk to a bunch of different VCs to figure that out if it really is
Because sometimes you'll get traction in areas you wouldn't have expected if you just isolate yourself to the top tier brands. I guess that's there are there's two scenarios. Either you think the market's smaller for your company, but it's actually bigger, and you don't even know what you don't even know. Okay, or, and this is more common, you think your idea is a change the world billion-dollar idea, which is the virtue and the vice of entrepreneurs. But in fact, most investors will think that it's actually a $100 million idea or a $50 million idea. And so what'll be interesting is that you'll go through a bunch of pitches, and most VCs, and we'll get to this later, will not say anything explicitly negative, but it just won't be a fit. Okay? And there's this temptation to get into this dance of trying to make it perfect for that VC, when in fact that's the wrong mindset to have. The right mindset is to find out where there's the right fit. And sometimes you might not even know what you don't even know about where the right fit is. And so this is more a problem if you think the market's a big market. I would encourage you to pitch a whole variety of funds. If you think the market's a small market and you find a VC that you like, then go for it and be happy. You don't need to pitch the big guys. It's less of an issue there. Okay? But there's a virtue to just pitching a mix of different VCs, because the venture capital industry, I will say, is not like, it's not an industry. It's really more like the mafia. There's like a bunch of different mafias, and they're all like these little fiefdoms, okay? And they all have their own little rules. And you have Sequoia Capital, or you'll have Draper Fisher Jurvetson, and you're really talking about 20 people. And if you look at the 20, you're really talking about 5 people. And it's a little mafia, and they have their own little idiosyncrasies. And you can't really know what that mafia thinks unless you dance with them. So just dance with a bunch of mafias, and you'll feel where you fit. Versus trying to think about, what does it take to get into venture capital or get a check from them. Okay. So here's the dynamics of this beautiful dance that you're about to get into. The venture capitalists will most likely not fund you. Just to give you some harsh news, they'll fund like one out of like every couple hundred companies that they see. But they'll want to meet with you because they want to see everything. And because if you think about what a venture capitalist has to go through, they can only make a few bets. Their time is critical. And actually, Helen, also tell me when we have 40 minutes left. Their time is critical, and so they can only make a few investments, but they don't want to miss out on the next Google. They don't want to miss out on the next Microsoft. Has everybody seen that slide? Would you have guessed that this would have become Microsoft? And it has like the prepubescent Bill Gates and like the other people from. So you never know where the next hit's going to come around. So they want to meet everything, but they'll most likely not fund you. And when they do think about funding you, this is what's going on behind their head, whether they're explicit about it or not. They're going to think it's two competing forces. They're going to first think about, well, why do I have if you are fantastic, why do I have an advantage over all the other VCs that are here? So it's and this is, I don't want to overplay this, but the whole Groucho Marx quote that I would never go into a club that would accept me as a member. It's not to that extreme, but you have to question why you're getting the deal versus all the other VCs. And typically, it's going to be because of one of two things. Typically, it's going to be because they're going to perceive you as a textbook winner that checks all the boxes in their schema or criteria of what success is, and probably checks the boxes of a bunch of other VCs, and they're going to want to chase a winner. So it's sort of like, Vinod Khosla had that quote when he funded, I think it was Vinod Khosla, it might have been John Doerr, it might have been none of them. He had that quote that said, "Never has so much been paid for so little." Right? It was $20 million on the 90 pre for Google. And the reason why they did that was because it was perceived to be a winner. And they were willing to make that investment and pay up on price because they thought that it was going to be a huge company, and they were right. And then the other side is to make contrarian investments, where I'm going to invest in companies that other VCs don't like because I think there's potential, either in the person or because I know a space or because of something else. And the classic example there is Hotmail. Hotmail pitched, I think, 30 some odd venture capitalists before they went to Steve Jurvetson at DFJ, and he wrote them a check and took a significant percentage of the company. So he made a contrarian bet where he owned easily double digits, I think north of 30% of the company for $400,000, and then sold it for $400 million 18 months later. And so that was a contrarian bet. Or it's because you come in through a personal network, which is, and so they'll have a bet based on affinity, and they'll get some type of exclusivity based on affinity. But that's the psychosis that's going inside of the VC, is that the VC, and this is not, I don't want to stereotype the whole industry, because again, the most important thing to realize is that venture capital is not an industry, it's a set of little mafias, and each mafia has their own little rules and norms, and they're legitimately different. But to the extent that you have to put a psychosis on the venture capitalist, the psychosis is that he's a hunter, or she is a hunter, okay? And so your greatest asset, in my opinion, is the scarcity of your supply. The scarcity of your equity. The fact that you can only take in one check. That drives your value. And so everything that I think you do, to the extent that there's an art or a dance to this game, should be about signaling a restriction of supply to you. If you prostrate yourself as dead prey and say, please help me, please like my business, what do you think of my business? Am I fundable? You are signaling to the VC that you are that certainly supply isn't scarce for you. That you are actually prostrating yourself to them, and you are viewing them as the supply that's needed. So that either explicitly or implicitly is signaling the availability of supply to you. Now, when in fact your valuation is not driven by the average number of the average value that VCs are going to give you. So if you get 100 different VCs to give you term sheets, it's not like your valuation is the average of those 100. Your valuation is driven by one VC. It's driven by that marginal optimized venture capitalist who's going to write you that term sheet, because you only have room for one. Okay? So you could stop your fundraising process in a week if you can get that one VC to give you the terms that you want, and you can close it. But everything then, I think, should be around restricting supply to you to get the price and all the other terms optimized to your advantage. And that's your greatest asset when you're going against the venture capitalist, is to know that you can only take a room for one person and to drive everything accordingly. What does that mean? That sort of, I think, bakes in a bunch of different ways. Everything from your posture to tactically how you pitch. But in some senses, it means that you should never pitch, okay? Because pitching means that I have supply. The other approach is to say that I'm not pitching. I'm meeting with you because somebody else has told me that I need to meet with you. And I'm heads down fundraising, and I'm interviewing VCs who I like for my next round. And that's an extreme position, but if you do that, one, the VC can never say that they dinged you because you weren't ever pitching them. And two, if they like you, they will naturally reel you in, okay? They'll naturally opt to want to give you cash. But if you are, in some senses, if you think about yourself as interviewing them, it's again restricting supply to you. The other thing is that you should be fundraising off of, you should never be pitching. You should be you should be in the process of being a frolicking deer. So you should be raising off of a milestone that you've just completed. So you should be saying, we just launched our beta, and we're ramping at a 30% month-over-month growth, and I'm running, and I am coming off of a milestone where things are moving forward, and I'm meeting with you because John, my lawyer, really thinks highly of you and thought that I should take this meeting. Okay, but you're something that's running and moving forward. And so in your mind, what I want you to do, just philosophically, is separate out the cash from advice from governance. Because those are all three things that a lot of people think about venture capitalists as providing. And there are some phenomenal venture capitalists who do all three beautifully. And they can also all be distinct. So you can easily create the advisors you want with an advisory board position or an independent board member position. You have that in your discretion. Okay. In terms of governance and control, we'll go through the board of directors. the person who serves on your board doesn't have to be the largest check. You can get the largest check from somebody else and have a minority person lead the round and be the board rep. So that can be separated too. So everything is, there are no rules, okay? That's what I want to sort of inculcate into you. This is a dance. You're a frolicking running deer who has restrictive supply. And think about trying to find the best match for you. Yeah.
Just on that, so
yeah.
Can you talk through like what the process would be? So you said the first time you reach out is your lawyer has given the introduction. You say, we've got all this positive momentum, but we're meeting. My lawyer's
right.
to meet with you. So there's that. Then what happens next? Because sooner or later you have to give them the full story. So is it step one, step two, or are there a few steps in that?
So my advice on that is to pitch. My advice is to start practicing with a few informal pitches. Those can be coffees. Okay, they can be until you feel you're at the point where there is enough sensation coming back where you're starting to get reeled in for an investment. Now is a fantastically frothy time in the market. And I believe that fundamentally this is a market, you're not evaluated on the intrinsics of your company. You're evaluated on whatever price you're going to get in the market. So in terms of process, once you feel like the pitch is there, when you're and you think that the timing is there, that it's time to raise, I am a big fan of making it an incredibly intense and short process. And by that I mean I would line up a minimum of 36 different possible investors. And in your mind, think about how many active meetings you can handle at your limit. I like the number 12. Okay? So what I would say is you want to have 12 active discussions happening at any one time. And by 12, I mean you're either, and this is advice from actually another VC who I should give credit for. Josh Stein has this approach, and I don't know if I should edit that out. But I think this works really well. You should either what I would do is determine mentally how many pitches can I handle actively at a time and set that number. Maybe it's 8, maybe it's 10, maybe it's 12. Reach out to prioritize your list of 36 so that you have the top 12 that you would want to get funding from. And segment it so that at any one time you have a mix of different types of VCs. This is back to Samir's question. So it should be like a third, maybe it's like a third top-tier venture capitalists and angels, a third second-tier venture capitalists and angels, and maybe a third strategics and really wealthy angels or something like that. But it should be a mix. And the active 12 should be a mix of those different types. And then once either a VC says, I'm not interested in you, or does not respond to an email within 5 days, assume that VC is not interested and put another VC in your pipeline in the queue and reach out to them. Or whatever process you're using to reach out, put them back in the queue. And the goal is to get to a point where you push everybody along so that you have 3 term sheets when you actually are trying to close your round. So the way that process works is that you do a lot of initial meetings, suddenly somebody reels you in, and then you go to one of the VCs that you've pitched before, hopefully somebody you like, and you say, hey, I just wanted to reach out because I've been actually proactively pinged for a follow-up meeting from another venture capitalist, and I want to make sure that my timeline lines up. I really, really enjoyed meeting you, and I would really love to work together to the extent that there's a fit, but I need to make sure that that happens within my correct time frame. Would you be interested in another meeting? Okay, so you push that conversation with them, and they'll either say yeah, or they won't reply, or they'll say no. And then you keep doing that process until you get to the term sheet stage. Then you're like, hey, I'm going to a partners meeting on Monday. Are you guys interested in, and I really liked you and I really wanted to keep in the process. Would you guys be interested in continuing the process until you get to the term sheet stage?
So it's a matter of juggling them so the term sheets kind of arrive
at the same time. Because typically once you're at that stage and you get that term sheet, you'll have a very short fuse to make a decision. So it'll be too late to start engaging with other VCs. And it's because the VCs don't want to give you the term sheet and have you shop it around to other VCs. So once you get to that stage, you'll have to have a bunch of people already at that stage too, or your prospects lined up, and then you've got to go in for the for the quote unquote kill, but not. But we'll talk about this. There's the term sheet. The valuation is just one thing. You want to think about the people and all of that. But once you make that pact, it's a quick, intense, short, and long-term commitment that gets made. You'll have to make a decision. You'll have to make a decision in a short time frame, and then you'll be with that person for 5 years. Okay. Does that make sense? Okay. 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 So I don't think there is something. I don't think there is anything as the ideal pitch. Okay. So I don't think there is somebody who's like the perfect entrepreneur pitcher or the perfect fundraiser. And it's because venture capital is not an industry. Venture capital is a bunch of little mafias. And you have to know how to cater if you're talking to the red mafia or the blue mafia in terms of what they're interested in. And so the best entrepreneurs cater the pitch to the VC. Okay, and so here are my tips around that. The first thing is that most venture capitalists don't want to disclose. They don't want you to dislike them, okay? Because venture capital is not a precise science. FedEx. Do you guys know about FedEx? FedEx raised, what is it, 10 rounds? They went to a Series H, which is, I think it's, is that not? Is that 10?
10 is J.
10 is J. 8. They went to 8 rounds of financing. Okay, and they recapped at the Series H, which means that they all the Series H investors made money, and everybody else got. I think they got washed out. That might be not totally accurate, but it's directionally correct. Okay, but the point is that most venture capitalists aren't going to know when they're going to want to be involved in your company, and they don't. And it's hard to predict what companies are going to succeed or not. So very few are going to. There's very little incentive to piss an entrepreneur off. Okay, and in these interactions where you have to make serious judgments in short periods of time, it's far easier to hold your reservations back rather than to disclose them if you think the reservations aren't changeable. And so, ironically, the best time you have, in my opinion, to get feedback on what the entrepreneur or what the VC thinks about your business is before you even speak. Okay? Because once you start speaking, you're going to set your biases out on the table of how you're thinking about the business. And if you hit a religious hotspot for a VC where they just religiously disagree with you, they might mentally make the decision that you're not a fit, but not disclose that to you. Which is why for me, it's important to try to suss that out early on. And the best time to do that is actually at the beginning, I think, or in the process. And so what I'm a big fan of is the B button. Okay, and this is more of a metaphor than anything else. But if you hit the B button on your PowerPoint, it blanks out. Okay, when I do that, all you guys look at me. So you're like, what happened to the screen? And then you'll all turn to me. Okay, that's the perfect time at the very beginning to set context for your pitch. And for me, this is the most important part of a pitch, is before you even start going into the details. And you want to do a few things. First, you want to set the context of why you're there. So most venture capitalists live harried lives, and you want to remind them how you got connected into them. And you want to reinforce the fact that you're a frolicking deer. Okay? So you want to sort of say, if it makes sense. So you want to say, let's say it's the second meeting, you want to sort of remind them, you want to say, hey, just as a recap, I came in here 2 weeks ago and met with your partner, John, who suggested that we meet up. I actually have not been actively fundraising. We've been working really on our product development, but James, my attorney, really thought highly of you guys and so recommended that we meet. We've been pulled in to a bunch of different venture capitalists actually for fundraising, and so now we're starting to think about it in a more structured way. Okay, so set the context. Then you want to sort of explore. In your mind, you want to sort of classify what type of VC are you talking to. And there's a whole bunch of different types of VCs, but some VCs are going to be more Series A seed VCs, and others are going to be more Series B, C VCs. And the other way to phrase that is some VCs are going to be more motivated by the idea. They're going to be, do you guys know Myers-Briggs types? They're going to be the N's versus the S's. They're going to be more around the patterns and the possibilities and the concept and the storyline of what it can become. Other VCs are going to be much more tactical, and they're going to be more focused on the specifics and the data. And there's a whole bunch of different ranges, but you want to get a sense of who you're talking to across the table, and you want to start to guess what their sweet spots are for when they're going to write their investment memo to the group or endorse you as a company, what's important to them. And you sort of want to start figuring that out as you're pitching, but also in the beginning it's a great time. So what you can say in the beginning is you can ask them, have you had a chance to review any of the material about the company before the meeting? A lot of times they will, a lot of times they won't. Okay? If they haven't, you might want to say, well, you might want to sort of crisply summarize in 2 sentences what you're doing, and then ask, well, just knowing that, or knowing what you've seen so far, are there any key issues that you want to make sure that I address before our time is up? And then that's the time when they can sort of self-disclose if they have any issues before you've sort of made a religious statement about, what you believe. So they might say, you're going after small and mid-sized businesses, and I just think that that's an awful space to go after because, for me, it's impossible to get distribution or penetration then. And it'll be like, aha, distribution's important to this person. Or they might say, I'm really concerned about if the technology is differentiable because I think the space is so competitive. And then they'd be like, aha, I have to really focus on competitive differentiation. And you'll be able to get a sense of what type of person this is. Do they know about my space? Do they not know about my space? If they do know about my space, what are their biases? And if they don't know about my space, how do they invest? So start thinking about those things. And that's why my strategy for this is that I'm a big fan of the minimal deck with a thick appendix. So the minimal deck is just the minimal number of slides you need. And this is sort of like what Chris Duggan was saying earlier, to get the VC to start talking about what's important to them without revealing too much because it's unnecessary. So I think you can do a minimal deck easily in 12 slides. And then have a thick appendix where if the VC wants to take something to a specific issue, then they'll tell you, and then you can go to that part of the deck that you can start to flesh out more. But until they make it an issue, there's no need to make it an issue. The only risk of making it an issue is that the VC you might hit something that the VC doesn't like. So I would try to think about crystallizing the key topics down to like 12 different slides. Another small thing is don't talk to them about their failures. Like, don't bring up companies they've invested in that have failed. This is a small thing, and if you can, ask them questions around their successes. And one, they subtly might associate you with that success. But two, there's also a reason why you're talking to that venture capitalist, and they'll want to know why they have a competitive advantage over the other VCs in the room with you. And if you talk about other companies that they've succeeded at and why you admire them for that, then that gives them skin in the game with you. That's a reason why they mentally know that you like them. And keep in mind that for your stage, for the seed and Series A stage, the big issues are typically around the team and the market. And these are the issues that the VC might be thinking that might not be explicit. The first is, do I like you? Okay? A venture capitalist, once they sign that term sheet with you, has to spend 3 to 7 years with you. And that means that they have to go to board meetings and see you. And they have to be able to talk to you if things are going bad or even if things are going well. So the first thing is, even independent of the company, a lot of VCs not only, but they'll like to invest in entrepreneurs that they like. So do I like your energy? Do I want to spend 5 years with you? Are you passionate? And there's a bunch of bifocal things, which is really hard about the industry, that you'll have to balance. They're going to want to know, one, do you have energy and are you passionate? And are you coachable? And the best entrepreneurs are both. Okay? You both have energy, but you're not stuck. You're coachable. So you sort of want to communicate those things. And then you also have the bifocal challenge of trying to address both hurdles that most VC funds have, which is your market has to be big enough and your entry point has to be specific. So you can be faulted for having a fantastic idea, but it's too small. It's just not a big enough market for our fund. Or you can have a fantastically big market, but we don't think you'll get traction. We don't think you'll penetrate your initial market. And you have to be able to handle both. So it's a bit of a dance, and you want to figure out how to best do that. Okay? Okay, now we're going to jump into more of the technical issues around term sheets. On the strategy side of pitching, there's a lot of great material out there. The venture hack side is fantastic. So look at venture hacks. Look at the Mint slide deck. Look at, in terms of thinking about how you want to structure your deck, decks these days are getting very lean. So I'm a big fan of starting out with just hitting the team, the market, and then going straight into the product and the demo as quickly as you can, and then putting all the other pieces that you think are relevant after that. Okay. So now we're going to make you guys ninjas on terms. Now, a term sheet is called a term sheet for a reason, and that's because everything's a term. And the valuation is just one term. The valuation is not, a lot of entrepreneurs hang their intrinsic worth as an individual on what valuation they got. Like, what was your pre-money? What was your post-money? So the first thing you need to understand is that your valuation in early raises is not at all based on anything intrinsic, unfortunately. Your valuation is solely a function of the cash needs of the company and the ownership needs of the investor. And your post-money valuation is literally just the cash needs that you can convince your investor that you need, divided by the ownership percentage that you can negotiate with that investor. That's it. If you need, that's it for most funds. And again, this goes back to the issue before, that most large funds are far more time constrained than they are cash constrained. So what's far more important to them is the ownership percentage, the denominator, than the numerator, the cash needs of the company. So suddenly, they would much rather own, let's say, 20%, which is a typical hurdle of a company, and pay you more than own 15% and pay significantly less for that 15%, which drives up your valuation. So suddenly you're raising, $2 million instead of $500,000 for the same percentage, for 25%. And your valuation then is suddenly $8 million post instead of $2 million post. But that valuation is not at all a function of anything intrinsic about your business. It's just based on the market. It's just based upon what the cash needs and the ownership needs of the company are. The trick is that you sort of get that card once, maybe twice. And then when you do the next financing raise, and maybe 3 times, if the market's good and you hit it. But typically, once you get into the future financing raises, you're going to start to be valued based on fundamentals. You're going to start to being valued based on metrics and then multiples on those metrics. And as you get further and further along towards going public, you start to get into public market valuations, which are comparables and financial metrics with some multiple to come up with some valuation. So the trick is that you sort of want to, a heuristic is that you want each successive round to be 3 times greater than the previous round. And your trick is to try to think about how to balance the scaling of your business so that for the next round of financing, on the traction and on the results, you can objectively raise at 3 times the valuation of the Series A that you're raising based on the idea and the potential. And it's very hard to pull off, and it does not happen more than it does happen. But that's something to mentally think about, is that sometimes it can be tempting to take a lot of cash off the table early on, but you really want to balance that against what your goals are of the company and thinking about how you're going to build out the company. Okay. Oh, so I got to make you guys ninjas. How many people read that case, the Trinity term sheet? Okay.
Pages 31.
The pages 31 to 41, and that weird thing that I scanned, that I sent you guys, how many people read it?
Doesn't mean we understood it.
Okay. That was a fantastic, rare sample of, in all honesty, that was probably one of the most onerous term sheets I've ever seen given. And so if you can go through that and understand those terms, the vast majority of the market is not going to be as onerous as that term sheet was. But it was a real term sheet, okay? So what I sort of wanted to do was make you guys ninjas. So to show you the worst, or to show you like an onerous version of a term sheet, so that you're equipped in that scenario, but to hope for the best, that you'll never have to deal with a lot of those terms, okay? So I'm going to try to just build in these ideas. So the first idea is understanding what the post is. So I would call on you guys, but I'm just going to talk through it to make it quick, and I'm going to call on you guys to figure this stuff out, okay? So this exercise is going to be figure out the post. The way that term sheet worked was that Trident, sorry, it wasn't Trinity, it was a Trident term sheet. Trident was offering a 2-tranched financing, where they said, I'm going to first give you $1 million, and there'll be an additional $200,000 that you can collect from your additional investors. And then I have the right to also invest an additional $2 million for the company later on. So I don't know if you guys read that part, but if you want, you can go back and read it. And they said that the valuation will be based upon the capitalization table heretofore enclosed. And they had this. Okay? So in this cap table, in the bold brackets, is the dollar amount of money that's being invested. And then the capitalization table is the shares in the company. What does that mean? 40 minutes left? Okay. That was like that. Okay, 40 minutes left. Okay. So can somebody, do you guys see the money value? How much cash they're putting in? Where that dollar amount is? 1.184. And then they're putting in, and then that's after an additional $2.2 million. They're putting in $3.1 million. And then do you see how much ownership? It's Trident Capital plus additional investors. That's the amount of ownership they have after that first tranche. That's the number of shares that they have. So my question to you is...
So it'll be 1.1 by 25.
Yes. So my question to you is... There's a few questions. The first question is, what's the post-money valuation of this company? The second question is, what percentage of the company do the founders own before the round? And that's it. Those are the two questions to know. And then what percentage of the companies do the founders own after the round, which is evident. So who knows what the post-money is for the A, and then for the first tranche, and then for the second tranche? Yes.
For the first, it would be about 4.7
So,
million dollars.
and Rohit, say how you're getting it.
So if they are putting in 1.1 for a 25% share.
And do you guys see how they're getting 25%? It's the 23.5 plus the 2.8. So if you look at Trident Capital plus additional investors, they buy 25% roughly of the company for roughly 1.2. So the post is
4.8.
1.2 divided by 0.25, which is 4.8. It's a $4.8 million investment. And what percent of the company did the founders own before the post?
90%.
And how do you get that?
Before, the 1.9.
Divided by 2.2, right? So the founders go from around 90% to what? What do the founders own after the financing?
28.2.
28.2, right?
28.2%. So they gave up what percentage of the company? 62% of the company. Okay? So they gave up 62% of the company. 25% was taken by the investors, and the balance went to the new investors, and the balance went to those other investors and the option plan. The founders probably owned less than 90% at the beginning because there's the other investors we didn't account for. What's the post after the second tranche?
6.5, maybe it's a little bit more than that.
It's
6.
And how did you figure it out?
Because everything else remains. I just took.
Is that divided by percentage, right?
Is the second tranche a flat round or is it an up round? Does that make sense? Are they paying more per share in the second tranche, or are they paying? Do you guys understand what I'm asking? So they're saying we're going to pay $1.2 million for 25% of the company, and then we have the right to put an additional 2%, $2 million, and we're going to end up with 40% of the company or 43% of the company. Is that additional money coming in at the same price, or is it coming in at a higher price?
It's a higher price.
Okay. How did you think about that?
The difference between 25 and 40 is 15%. That's now they're getting 15% for 2 million, and before they were getting 25 for 1.1.
Right. So you're saying that it's 25. So you're saying that it's 15% is being bought by $2 million. So that must mean that it's a higher price. So the way, let's see if that's actually true. The
It says it in the body of the text.
oh, does it? That the price is the same?
No, the price is different.
Okay.
The second round is a higher price.
Okay. How would you calculate the price? Do you know?
So it'll be total number of shares, right? Common stock, so 1.2 by 2.2 was the initial equation. But they didn't issue any more common stock though. So they issued preferential stock.
Yeah, I'll get into this later. Actually, this is too complicated. This is. Well, if we have time at the end, I'll come back to this, and I'll show you how to calculate the price and then the price per share. But the basic thing that I want you guys to take away is just it's the capital in divided by the ownership percentage. That's it. That's all you have to think about. That's the post. It's nothing intrinsic. It's just how much cash do you need and what ownership do I need. That determines your valuation. Did you guys see Factual? Factual raised a $25 million Series A. So they have a ridiculous valuation. But it's based not on that thing. I mean, Factual is a phenomenal company, but it's the valuation's based on the raise divided by the ownership needs. Okay, this is the so the first thing to check for is the valuation on the term sheet. The second thing is the employee pool. Yeah, yeah,
Yeah.
yeah.
Go back to that slide.
yeah,
So in the first table that you have there,
yeah,
so it says preferred A1, right?
yeah.
So at that point in time, the board got organized, right? So
Yes.
Two people from the fund, and you got two people from you and an independent, right? The other guys that came in afterwards, they don't get a seat on the board.
Well, the other guys that are coming in afterwards are the same guys. So if you look
in
at
this case, yes, but if there would be other guys that would invest,
the other guys that would come in later,
would they get a seat on the board or would they not?
it depends on how they structured the term sheet. So the way they structured this term sheet is that they specify what the voting process is for determining who gets those board seats. So I think they specified it here as a majority of the preferred, and you can either do it as a series or as a class. So you could say the majority of all the preferred shareholders, including the guys that come after it, whoever owns the majority, that's a majority vote, the majority gets to decide who serves those seats. That's typical. Or they might say, our class, the series A1, we are always entitled to one seat. Now the new guys might come in and say, that's great, but I'm changing the rules. And to accept my money, you have to change the rules. Okay.
So did they create a separate class of shares here? A new class of shares?
They created, they did. They created an A2. It's a separate class because it has a different price. But a lot of the rights will be the same. So they called it an A2, not a B. Tranched financings are not normal. I mean, they do occur, but they're not normal. We don't need to get to that level of sophistication just yet. That'll be Venture Capital 102. Okay. Employee pools. We talked about this already. But the employee pool will have a very significant impact on your dilution. Okay? It's not but it's almost as important as the raise, as the cash raise. So it's critical that you understand this. And I've seen very sophisticated entrepreneurs who think they get this, not realize the impact that this has. So remember that diagram that Sam put up on the board where, let's say you split it down the middle. I said 4 on 4. And then I want to have 20% of the company have an employee pool. I can take that 20% either out of your half or my half or both. But the norm is that it comes out of your half, out of the founder's half. And so they call that coming out of the pre-money. When they say it's coming out of the pre-money, that means that it's coming out of your share. Now, what happens if you run out of the employee pool? Does anybody know? What do you do? Like, let's say you use up your employee pool and you need to hire somebody.
Issue more shares.
You issue more shares. And who faces the dilution when you do that? Everybody. Okay? So, in some senses, it's to your advantage to negotiate the least amount of employee pool that you can tolerate, knowing that you can always approve a discretionary increase later, and then everybody's equally diluted. But the venture capitalists will typically have a provision where they'll want to have some employee pool reserved. But there's some degree of flexibility there. I mean, the normal rule is 20%, and the earlier stage you go, the bigger the employee pool they'll want to carve out. And there'll be a certain limit that will definitely be a deal killer, but all things being equal, the smaller the employee pool, the more ownership you got to keep until you need to decide later. So I want to make sure you guys get this. So we're going to do an exercise. Kirsten, do you want to do this? Okay, so Kirsten, you own 40% of a company. A VC wants to put in $2 million for 25% of your company and requires a 20% employee pool pre-money. What's the post-money valuation?
valuation is that 8.
It is. How'd you get that?
You only need
5%.
two numbers of it.
You only need 2 numbers to come up with a post. That's it.
The 25%.
That's the place where you start. What are the 2 numbers? You just need cash in and new investors' ownership needs. Okay, that's the post. Now, what percent of the company do you own afterwards?
Okay, so
So you own 40% of a company before.
So it's
I shouldn't
40%
eat.
of 70%? Oh, 75%.
well, 40% of 125%. So 0.4 over 125, wouldn't it?
Okay, so walk us through, think about it, walk through the process out loud.
Well, you just added 25%. No. Well, your 40% is less when they add the 25%.
Your 40% is less when yeah, that's right. How much less is it? How much do you dilute by?
By a fifth.
By a fourth. You dilute by the same percentage. You dilute by 25%.
Okay.
So if you own 40% of a company and a VC needs to own 25%, everybody, including you, dilutes by 25% to make room for them. Does that make sense?
Yeah.
So I own 40%. I have to give up my share of that 25%, which is 25% of 40%. So it's 25% divided by 40%, which is 10 absolute percentage points. So the VC comes in, and my ownership goes down from 40% to 30%. Does that make sense?
Yeah.
But then the employee pool wants 20%. Now, what percent? How many points do I have to go down to make room for the employee pool? Okay, who wants to help out?
It's less.
Sumi. What? Sumi? What?
Is it 8%?
8%. Right. How did you get that?
40 into
40.
into 20% is 0.2.
Yeah, 40 times 20%. So I have to dilute to make room for the employee pool. The employee pool needs to be 20%. That's going to come all out of my hide, not out of the 25%, which is the new money, because all this is being figured out pre-money. So pre-money means that all the dilution for all the stuff comes out of the pre-money, and that means that's you and your other investors and whoever have existed before that new investor comes in. Yeah.
The question is that there is nobody with premium. Shouldn't it be actually 100%? So why would it be 40%?
Oh, because you might have a co-founder.
So then wouldn't the other ones also get diluted? Why only the co-founder one would get? Wouldn't it be that everybody else would be getting diluted?
So the question is, why is only the founder diluted? Doesn't everybody else get diluted? And why is it 40%? So it's 40% because presumably you might have another co-founder. So let's say you have another co-founder who owns 60%.
Yeah.
Okay.
But that's the assumption,
So
that
then
there
wouldn't-
was no pool before.
There was no pool before. So the assumption is that there's no pool before, or this is an incremental new pool of 20%. Maybe there was a 5% pool, but they want 25%. Okay? So this is the incremental new pool that needs to exist. So, and then the question is, why doesn't everybody else get diluted in the pre-money? Everybody else in the pre-money does get diluted. So of that 25% that the VC needs to own, you're chipping in 10 of the 25%. You're giving them 10 percentage points out of your 40, and you're going down to 30. Does that make sense? And then of the 20% that the employee pool needs to be, you're given 8. So you end up with 22% of the company. Okay? So it seems sort of innocuous that the VC is saying, I'll give you 2 for 25%. But really, it's almost 50%. Okay? Because the employee pool is knocking you down a lot. So make sure you understand that. That's non-trivial. And it's significant, and it's sort of said sort of flippantly. So even if you knock that employee pool down from 20% to 15%, you've just saved yourself 2 percentage points. Right? That's significant. That's like a VP of, a vice president. Yeah. I mean, yeah. Mike.
Just had a question on the aspects of the employee pool being 20% in a what might be a boom like we're in now.
Yeah.
Or at least a more frothy times.
Yeah.
So is it in our interests to try and minimize the employee pool because of the percentage points, or is it in our interests to keep it at something like 20 so we can attract talent to help make the pie bigger?
Yeah, it's in your interest to make the pie bigger. In general, I think you want to have enough currency to fight the best fight you can. And so there's nothing philosophically wrong with the employee pool being 20%. And And for the right VC, they won't invest unless the employee pool is 20% because they understand the importance of that. There's two issues. One is the size of the employee pool, and two is who takes the dilution for it. So in general, I'm a big fan of, especially early on, phenomenal talent is worth paying up for. So if there's the opportunity to get a game-changing athlete as one of the top 5 employees, or even the top 10, it's almost always worth it, unless it's an egregious amount. So in general, that I think you want to have the currency to be able to offer them. The question then becomes, who pays for that currency? And so even if you agree on the percentage, like it's 15%, it's a question of whether or not you can negotiate the VC sharing some of that burden. And for some VCs, it just won't make the math work. For them, they'll want both. They'll want the employee pool to be high enough so that they can have currency, and they want to pre-know that. A lot of this up front is making sure, and this is sort of the Sam's point earlier, not to be a hog, but you want to make sure that there's a mutual commitment on the vision of the company. And they'll want to invest in a company that has enough currency to get the best talent, so they might not want to invest if the employee pool is not a certain size. And then there's the question of who takes the dilution. And then they might not want to invest if they have to take the dilution because they don't want to take that risk. But that's just sort of the nuances of the game to think about and to keep those two things separate. And it's good to have that conversation up front because if you have to expand the employee pool later, if there's a disagreement on that, on either side, you need board approval for that, which is why the VCs typically want to bake it in the term sheet and they'll want to err on the side of being more generous than not. So that's the issue.
Question.
Yeah, Gertz.
And not to dwell on this too much,
Yeah.
but so I thought that, the Aura guy last time,
Yeah.
he was talking about actually setting up an employee pool just straight up.
Yeah.
Or isn't that a better idea so that you actually account it, there will eventually be a
so
employee pool, so may as well just make it in from the beginning,
so
and then you don't get diluted because you already have accounted for it,
yeah,
You and your co-founder is both 40-40-20, you're done.
and then
You
it's
don't
already
see
done.
it as oh my God, I'm
getting
going down, I'm getting scooped.
So Gertz's question is when we met with council last week, they said that you should pre-bake in the employee pool at 20% when you found the company, and if you did that, doesn't that obviate this issue? You can pre-bake it in. You take all the dilution when you do that early on, okay? So it saves the VC the hassle of doing that. That employee pool also gets diluted by the VC's cash. So after the round, the employee pool is not 20%, it's 16%, right? So the VC might ask you to top up the employee pool to 20%, or if there's a way that you can use that inertia argument, you might be able to use that with them and say we've already pre-planned it out. But so it's your call. It's your call. It could go either way. Okay, vesting and change of control. So the next thing that I would look for in the term sheet is, have you been put on a vesting schedule? Did the VC say you have to, if you leave tomorrow, you get nothing of the company? And most venture capitalists want you to take them as seriously as they're taking you. They're giving you all this cash. They don't want you to leave tomorrow. By the way, we'll do that next. Okay. So check if you've been put on a vesting schedule, and then check what happens if you get acquired. Okay, this is the single trigger versus the double trigger thing that we talked about before. See if there's any change of control, and that's called a change of control provision. If there's a change of control on a double trigger or a single trigger, or if that's even mentioned. And you might want to think about the issues around that.
Is it common for your vesting schedule to get restarted?
It's not uncommon. The question was, is it common for your vesting schedule to get restarted? It's not uncommon. It depends on how long you've been investing. They might give you consideration for the time that you've already put into the company, but they might want you there for 4 years. And you can push back on this, okay? Because if you look at the data, companies succeed either way. I mean, your main motivation should be the fact that you have all this equity in the company. So your wealth is built upon this company succeeding, and you don't want to, and so the vesting shouldn't matter. I have seen situations where entrepreneurs have successfully pushed back on that. You just have to think about what fights you want to fight, okay? But it's not uncommon for them to put you on a vesting schedule and maybe give you some consideration. Did you read this one? Did you guys? So this is what the venture capitalists did here. It says, all company equity interests currently held by employees will be subjected to vesting arrangements, and it goes through the details of that. And then it says, if you look at the, and then it says, except that, and then if you look at the second colon, 25% of the equity interests held by each of, and it names some of the key employees, will be deemed vested as of the initial closing. I think that's, and then it says, in addition, if Rich Early resigns as the company CEO at the request of Trident, an additional 25% of equity interests will be vested. So they want him to resign. Does that make sense? So they're saying, we'll give you more equity if you resign. Okay. 20 minutes left. Okay, we got to go. Okay. Okay, so check vesting. Next thing to check is board composition and CEO role. So check for how many and what's the split between the preferred, the common, and the independents. Do you guys, so the board, okay. So the board makes the decisions, not, so the board is more important, as Sam was saying, than the number of shareholders. They actually get to determine what the company does. So the majority of the board is the thing that ultimately drives the company. So you want to determine who controls the majority of the board. And given that the board needs to make decisions, it's much more common for it to be, I don't know if it's required, but it's by far the norm for it to be an odd number, not an even number. So it'll be 1, 3, 5, or 5. And then typically, the number will be split between the common, the preferred, and the odd will be what's called an independent. And you want to look at how that independent is chosen. What's the board's main responsibility? If you had to say that the board had one responsibility, what would you say it is? That's right, fire the CEO. When to hire and fire the CEO, okay? I mean, it's a very crude instrument, it's a very important instrument, but tactically that's the one thing that they can do. So you want to determine who gets on that board and how. Did you guys read the term sheet? Did you see how did anybody see what they did that was sort of tricky? Okay, so if you read the term sheet here, it splits the board between 5 directors, 2 of which are preferred, which they call underlying stock, 2 of which are common, and 1 whom shall at times be the company's then, 2 are common. 1 of the common is the company's then serving CEO, and the remaining shall be an outside director that's voted on by the majority of both the common and the preferred, okay, each. So that's how they split did you guys see that? So that's that's a typical split, okay? They stipulated that the CEO has to be one of the common, there's 2 common, 2 preferred, and 1 independent. But then, they put this little thing in there, and you should look for this, some people it's in, they put in a provision 8 called the Chief Executive Officer, and they said Trident will have the right to designate a person to replace Early as this Chief Executive Officer. So the investor, so this obviously is a case where the investor saw a fantastic opportunity in the company, but they thought that the CEO was a bottleneck to the company's success. And so they stipulated that they have the right to designate a person to replace the CEO. So effectively, who controls the board? The investor, right? Because if one of the 2 preferred seats has to be the then serving CEO, the investor gets to decide who the CEO is. The majority of 3 of the 5 board seats are in the control of the investor. Okay, so just look out for something like that. That's rare, and it's unusual. So, but you should just know about. You should pay attention to that in terms of the order of priority.
It's more common in like Series B or Series C, and rare in Series A, or
it's not common.
Remember last weekend, I think you asked about how Zuckerberg had 3 of the 5 board seats.
Right.
That never happens, right? Where an entrepreneur.
So an entrepreneur asked for 3 of the 5 board seats. It does. So sometimes you have 3 founders and they all want to be on the board. That's a common issue. I don't know what Zuckerberg. So first of all, everything's negotiable. Okay. So there are some investors that will just give you common equity. They won't want to even serve on the board. They won't even ask for the board to change. And you could get an investment check and have no board change. Okay. If Zuckerberg, I don't know the details of what he negotiated, but you could negotiate saying, I need you to have faith in me to drive the direction of the company, and I'm not going to take cash from somebody who wants to have control of the board. I'm happy to have you on the board, but you have to have I want to own the majority of the seats. It's a very hard position, and a lot of investors will say no, because they'll want to have at least equity or fair balance. The reality is that the best companies like Facebook, it's not the VC that builds them, it's the entrepreneur. So really board provisions are structured as mitigating controls to mitigate against damage. But if companies are succeeding, The board provisions rarely take effect. Okay. Okay. So the next thing is liquidation preferences. Why does preferred exist in the first place? Why can't we just give out common? Why can't I just give you money for common equity?
They get high priority in liquidation.
Right. But why is that important?
The VCs want to make sure they get
That
They
may
want to
not
make
be
sure they
enough
get their money.
to go around.
So the VC wants to make sure they get their money back. Yeah, that's basically it. I mean, the typical thing is also, let's say I said, here's $1 million. I'm going to take 25% of the company. You're starting at stage 0, and it's all common equity. On your balance sheet, you have $1 million. You could go sell the company for $1 million. And I own 25%, so I get $250,000 back. And you just took my capital, my equity, right? So from a financial perspective, it's a way to protect me from, I change the valuation of the company just by giving you the cash, and I don't want you to sell the cash as an asset. So I create a liquidation preference where I get the rights to any sell on that cash. But it's also important to remember that when somebody gives you a valuation, you don't get that valuation. You don't make a dime until you pay back all the money that you've taken in, right? So for most investors, like you hear like Color raising $41 million or Backshore raising $25 million in their initial rounds. The founders will not make a cent until they've returned $25 million or $41 million first. So keep that in mind. Things to check for here are, is there a multiple on the liquidation preference? So this is called an X. So if I say I'm going to give you I'm giving the money's at a 1x liquidation preference, that means that I get 1x my money back before you get any money back. If I say it's a 2x liquidation preference, that means that I get twice my money back before you see a dime. So if it was a 2x liquidation preference and I gave you $4 million, how much cash would you have to return before you started seeing a dime? $8 million. Okay. Then you should check if it's participating or not participating. Who knows what participating is?
That's where they take a portion of the sale as well.
They do.
Yeah.
So that's where they double dip. Okay. So participating means that not only do I get the first $4 million back if I gave you $4 million, but then I get my 25% of the remaining. Okay, so let's say you sell for $5 million and you took in $4 million at a 1x participating preferred for 25% of the company. How much does the VC get?
4.25.
4.25. Right, so they get the first $4 million, and then they double dip. Then they play again for the money, the last $1 million, and they get their ownership percentage. They get 25%. Okay. And then this doesn't become an issue until you raise successive rounds of money, but then the liquidation preferences can be what's called pari passu or senior. Pari passu means that it's on the same playing field as all the other investors. So let's say you've raised $500,000 of angel money, and then I give you $2 million, and I say that $2 million is a senior liquidation preference, and the company exits for $1 million, and I own 25%, and your angels own, let's say, 5% of the company. Of that $1 million, how much do your angels get?
It should be none.
None. Because I have a senior liquidation preference. So my liquidation preference comes before the other investors. The alternative is what's called pari passu, where I play with the other investors. So what do these guys do in their term sheet? Did anybody read it?
So why would somebody agree to that? I mean, why would liquidation be 3x the original cost when clearly you put 1x in?
Okay, so the question is, well, so first of all, what is this term sheet? What type of, so if you had to tell me what is this liquidation preference, what would you say it is? So you said it's a 3x. Is it participating or non-participating?
Non-participating.
He says non-participating. He's like, they shouldn't be participating. They're getting 3 times. It says, plus the greater of the greater.
It's non-participating. There's nothing, right? So it's the aggregate liquidation value or the aggregate amount we pay in respect of each share of common stock Or foregoing multiplied by the number of shares of common stock.
Actually, there's a paragraph after this. So right now it doesn't say. I think you're right. It says it's non-participating, but in the case of a stock-for-stock trade equal to the accrued and unpaid dividends, the aggregated liquidation thereof, or 2, the aggregate amount to be paid in respect to each share, assuming no payment of liquidation pursuant to close, multiplied by the number of shares. Okay. I think it's non-participating, but there might have been a paragraph after this. Was there one that I cut out? No. Okay. Yeah. So this is 3x non-participating preferred. Yes. Oh, 10 minutes left. Okay.
And it also doesn't mention anything about senior or pari passu.
Yeah.
It doesn't mention senior or pari passu.
So if it doesn't mention,
if it doesn't mention it, it's pari passu. Okay. Yeah. Although I think it does say.
I think it was in the next paragraph.
Actually, I think it's actually senior because it says upon any liquidation, the convertible preferred will be paid before any payment is made upon any other equity securities. So I think that's including the other.
I think somewhere in the term sheet it said pari passu.
Oh, it does say pari passu? Okay, great. So this is 3x non-participating pari passu. Okay? So what you should do at home is try to do like an XY diagram where, let's say you assumed that this company raises $3.5 million. Think about what the exit value is, and think about what the payout is to all the different constituents. If the slope is 1, that's 100% of the payout goes to the constituents. And so you can figure it out. This is a longer exercise, and we'll come to it at the end. But you should map this out. And you should see where the inflection point is, where the VC is indifferent between exercising their liquidation preferences or converting into your company. Let's say I own, very simply, let's say I give you $1 million for 25% of your company. And today, you can typically get it for, and tell me when I have 5 minutes left. Today, you can get that probably for non-participating 1x liquidation preferences. It's a great time to be fundraising. The terms are very, very gentle, or vanilla, or whatever bias you have. If I said, I'm going to give you, Chris, I'm going to give you $1 million, 25% of your company, senior liquidation preference, at what point of your exit value am I indifferent between having that liquidation preference or not? So let's say you exit for $1 million. Yeah. I want my money to act as the liquidation preference. I want my money to act as debt, basically. I want you to pay back my $1 million. If you exit for $2 million, I can take my $1 million, or I can say I want my position to be shown as equity, in which case I get 25% of the $2 million. So at $2 million, I would get $500,000 if I didn't exercise my liquidation preference.
It's the valuation of the company.
So it's the valuation of the company. Okay. So then do that exercise if it's 1x participating preferred. And then we'll do that later, but you can sort of map that out, okay, and think about what those different liquidation rates are.
Basically apply that equation and change the variables to see where the value comes out.
Yeah, see where the indifference point is. And that'll also determine where your incentives are with your VC. But in general, check the liquidation preferences. Just make sure, actually, for all the awful thinking that goes around liquidation preferences, is that if there's nothing egregious like that 3x, the other problem with the liquidation preferences is that your future investors will inherit these as the norms. So if you set a 3x liquidation preference and you raise more money, the new investor will want that. So the thing that you're doing now is you're sort of setting the precedent. So you want the precedent to be clean. That's also why it might seem innocuous to do a participating preferred on just like $500,000. But the difficulty becomes in the next round justifying why that new investor can't get the same rights when you're raising $5 million. Look at the protective provisions. The protective provisions are special rights the investors get to exert over the management. So it's normally the board will get to make all decisions. The protective provisions say, in these cases, it's the majority of the preferred that's required to make a decision. So we have a veto right if any of these things happen. And these things are typically things around acquisitions, raising more equity, and you should look through those to make sure there's nothing weird that's going on there. Okay? The next thing to check out is a pro rata right. Do you guys know what a pro rata right is?
You're able to reinvest to get kind of this, so you won't be diluted. You keep the same percentage of ownership in a future round?
That's right. So the pro rata right is that you keep the same ownership percentage in a future round of financing. So what happens is that, let's say you go out and you're really successful and you start to raise $10 million on a 30 pre, your Series B. You did 2 on an 8, you were 10 post, and then you did 3x. 18 months later, and you did 10 on a 30 pre. So you just did a 3x multiple. You're going to dilute by 10 on a 30 pre. How much do you dilute? You take the capital that you raised, you divide it by the post.
3%.
No. Because then if I said you raised 30 on a 30 pre, you would dilute by? If I said you raised $30 million on a 30 pre, how much are you diluting by? 100%?
100%.
No.
50%.
50%. So it's the amount raised divided by the post. I always get confused with that too. But it's the amount raised divided by the post. So you dilute by 25%. The VC has the right to protect their investment. So if the VC owns 20% of that round, they get to invest 20% of the raise so that their 20% ownership percentage doesn't dilute. So if you raise 10 million, they get to do 2 million of that round. Okay? That's called a pro rata right. That means I have a 1x pro rata right. Okay?
Does that mean they get first dibs at it, or does that mean they get stock issued for that much amount and they don't actually put in any money in this next round?
No, it means that they have to put in money, but they have the right. They have a claim on the next round to do that percentage of the next round. So if you raise 10 million, they have a claim to do the percentage that they own in the company of that raise. So they have the claim to do 20% of the 10 million. They have to do $2 million on those terms. Yeah.
Why would they do that? Just to protect the...
So the question is, why do they do that?
Ownership.
And the reason why they do that is to protect their ownership, so that they don't get diluted. Otherwise, every successive round, they're going to get diluted, and the VC needs to own 20% when you go.
They're putting more money.
And they're putting more money. They're paying for that to protect that dilution. But they need to protect their right. The reason why that becomes difficult was that then if you think you're raising 10 million, you're actually only being able to offer a subset of that to the new investor. And that new investor has ownership needs too. They need to own 20%. So the cycle continues. So the thing to look out for is that some people will throw in a super pro rata right. They'll say, I don't get a 1x pro rata right, I get a 1.25x pro rata right. Or a 1.5, especially now when VCs, there's so much jockeying to get into companies. Some VCs will say, I have the right to do 2 times my pro rata in the next round so that I can get to an ownership level that's meaningful. So you want to check to make sure that there aren't any super pro rata rights, or if there are, that you know about them. Okay, anti-dilution rights. Do you know guys what these are? Anti-dilution rights are, let's say you say, I think my company's, you don't understand my company. You don't understand how big this thing is. Then I would say, great, Gertz, I agree. You're worth $1 billion. I'm going to give you $1 million on $1 billion valuation, but I get full ratchet anti-dilution. What does that mean? That means that if you raise money in the next round at a $2 million pre instead of $1 billion pre, and the valuation is 500 times less than what it was before, my $1 million buys a third of the company. The price readjusts to whatever that next round is. So let's say you convinced me that the company was worth $100 million, and I gave you $10 million, and then you raised money at a $10 million valuation later. My money, the ownership that I own, is based on the lowest valuation that you end up getting after I give you the money. And so part of that is intended to broker transparency. You don't need to sell me. I'll give you money at any valuation you want, whatever you think is right, but I get full ratchet anti-dilution. That's called full ratchet anti-dilution. That's onerous, okay? And they put full ratchet anti-dilution in the term sheet. The type of anti-dilution, there's another type of anti-dilution that says, if the round is lower than this round, that's a little bit my fault and it's a little bit your fault. So I'm not going to take full ratchet, but I want to have a weighted average of this round's price and that round's price. And there's a complicated formula around it, but that's called weighted average anti-dilution, and it can either be broad-based or narrow-based. But if you look for that in the anti-dilution provision. So we're talking about anti-dilution, and what happens if you have normally the anti-dilution kicks in when you have a down round, when your next round is lower than your previous round. And oftentimes when that occurs, that could be because of the markets. And generally speaking, most venture capitalists know that the most successful ventures occur when their entrepreneurs own meaningful amounts. So it's very rare to have a mercenary CEO who, like a paid gun, who owns a very small percentage of the company. They'll want you typically to own a certain percentage. So if you get into a weird situation, and oftentimes in a down round scenario, there's a situation where a new investor has to come to the fore and nobody's coming in. And so you have an investor that comes in at a very low valuation, or you have an insider that comes in at a low valuation. So at that point in time, everything's negotiable anyways. Does that make sense? Like if you're doing the down round anyways, it's because the market hasn't been able to price the company based on where you're projecting the market to price it 18 months ago. So something's gone wrong. Maybe the market's changed, but maybe the company hasn't delivered. And in that situation, everything is renegotiable. So even though you have this provision in the Series A term sheet, the reality is that if you have a new investor coming in, they have the biggest influence power and negotiation power in that dynamic. So they can say, here's my term sheet, and by the way, contingent upon accepting my term sheet is waiving the anti-dilution provisions that the former investor had, okay? In which case they have to be waived. Or they can rejigger the term sheet basically to whatever they want. Or if it's the original investor that's coming in, the reality is that you're probably not going to be incented to stick with the company if it's such an onerous change. And the original investor, if they still want you there and they still want to invest in the company, they get that. And so they might give in on whatever was negotiated before. Which is why you rarely see full ratchet. But these guys put it in. So you should just know. And this must be in a very unusual situation. So all situations are different, so I don't want to be damaging towards any specific venture fund, but that's an onerous provision. Yeah.
Very briefly, something that came to mind, and this may be a really stupid question.
Yeah.
Is there anything any type of clause that would prevent the founder or CEO, founder CEO at that time, to just say, hey, screw this, after like a year, I don't like this, I'm walking away, and I have to like pay restitution or something?
So the question is there anything that would prevent, is there any term that somebody could put in that could handicap the founder and prevent them from leaving by forcing them to pay some heavy restitution if they left within a short period of time? There's rarely any. So first of all, everything's negotiable. So there might be something put in, and so you should look out for it. But typically, the way they do that is by taking your equity, which is why they might put you on a vesting schedule, and putting. Yeah, it's mainly the equity that you have to look out for. That's the main one. All right. Co-sale rights. Co-sale rights. This is not a term that most first-time entrepreneurs get. It's not a term that most second or third-time entrepreneurs actually get. But the really sophisticated entrepreneurs understand why this can be valuable. Co-sale rights say that if any of the, and you can word these in various ways, but typically it says that if founders are selling their equity, I, one, as the investor, get to the right to buy that equity along with any of the other people who are going to buy it, and I also get the right to sell alongside you. So what that means, at the same pro rata, so what that means is that if you want to sell, let's say, $1 million worth of equity, and our pro rata relationship of ownership is like 1-to-1 for every share that you own, I own a share, I get to also sell $1 million. So if you have a buyer that wants to buy only $1 million worth of equity, you can only sell $500,000, and I can only sell $500,000. The reality is the reason why they put this in here is that if the investor is selling the equity, it can be a red flag that something's wrong with the company. So the very act of me selling alongside you signals that something's wrong with the company and can prevent you from, and might prevent you from selling in the first place. So the intention behind the co-sale right is to align incentives. Now, I think, for me, the reason why this becomes relevant is that if you go for a home run business where you're starting to raise significant sums of liquidation preferences overhanging you in your Series B or your Series C, and you want to align your incentives with the VCs, depending upon the size of the fund that you're working with, are really gunning for a certain exit, okay? And with all the liquidation preferences that might be overhanging you, you're really going to be putting yourself into a situation where you're either going to shoot for the moon and have $1 billion outcome, or you'll be below your liquidation preferences and you'll get nothing. Which is why I think it's important, to the extent that you can, to carve out a certain percentage of your shares from being immune from the co-sale rights. And if they're immune, then you can actually sell some of those shares into the Series B. Does that make sense? So you could take some money off the table in the Series B and then align your incentives with the VCs, but it's too late to do that by the time you do the follow-on financing. And it's not a term that most entrepreneurs typically ask for. And the VCs will push back on you if you ask for too much, because they'll be like, why do you want to sell your equity? Aren't you in this for the long term? So I love it if, for my entrepreneurs, if you can ask for like a 5 or 10% or 20% immunity of your founder shares from the co-sale right, that I think gives you currency in the next round to have some liquidity where you can take some money off the table so that you can save it for a rainy day if the venture doesn't succeed, if you're going to go for the moon. Yeah.
On that point about taking money off the table, isn't there a problem if you have common stock but investors want to have preferred stock?
So the question is, on the issue of taking money off the table, isn't there an issue if you have common stock and the investors want to have preferred stock? So so the price might be different because your stock does not have the rights of preferred stock. But a lot of, again, the biggest asset you have is the scarcity to the supply of that equity. And a lot of investors are going to be, this scenario comes up when you're having high raises at high valuations in later rounds, when it's generally less of an uncertainty if the company is going to have an exit. So once the company goes public, all of the shares converge. So the common and the preferred become the same. And most people that you're going to be selling into for these rounds care more about their ownership percentages than they do about their liquidation preferences. The liquidation preferences are only important on the downside. So you probably won't be able to sell your common stock at the same price as the preferred, but you could sell it at a discount, and it would probably be at a price that wouldn't be as reduced as you would expect. The difficulty that this gets into, which is a little bit more of a complication, is that you can pollute the price of the common for your employees, because suddenly you're striking a market price for the common, and then all of your employees who are buying in at that level will have to buy in at the price that you sold at. And there's tricks around that. So there's legal mechanisms where you can structure it so that it's not considered a stock purchase. It's a complicated transaction where the stock is one element of it. But you can't even engage in that if you don't have the right to sell your stock. So, yeah.
You can be selling your stock to, who will be the buyer of that stock? The new investor or another third party?
So the question is, if you're selling the stock, who would be the buyer of that? The new investor or another third party? Either. You could have a new investor so the scenario where this often plays out is you have a new investor and they'll be like, I want to invest, but we really need to get to 20%, or we really need to get to 15% to make that important. And there's only 10% available in the round of preferred. And you can say, well, I'm going to give you 10%, or I'll give you, maybe we'll be able to get to 12.5%, and 2.5% will be common out of my shares, and that'll end up becoming 15%. Yeah.
How is second market changing the dynamics of this, where, like the Zynga early employees are selling into this?
So the question is, how is second market changing the dynamics of this?
Or maybe it's like,
I don't know. I don't know how far much second market's gotten into. This oftentimes comes into play in the Series B, which I think a lot of companies are actually before the second market stage. And I don't have enough clarity on that. Okay. Okay, good. So then there's a whole bunch of other terms, okay? But the other terms I've rarely seen cause catastrophic issue. So there's a bunch of other terms, and if you have questions, just ask counsel or your advisors, and they'll give you their feedback on them. But the terms that we went over are the ones that I would just look for to dissect quickly a term sheet. That's it. That wasn't too bad, actually. Okay. Any other questions?
Got a question on like, because we're in these frothy times, etc.
Yeah.
I'm just wondering what is for the seed stage. A couple of years ago, the amount that the investors were needing to own was probably more towards the maybe 40%, maybe 45%, say.
Mm-hmm.
Well, what would it be now? I mean, it's obviously changed in the last 6 months, 12 months. Do you have a feel for that, Ravi, at all? Like what range, maybe?
Yeah. So the question is, at the seed stage, what are valuations going for typically today? What can you get? And the first thing is that it's completely a function of supply and demand. So this is, again, the whole thing about how it's the marginal value of that investor. And I did not emphasize this enough, so I should take a moment to do this, which is that these are long-term relationships, so you should really look at your investor as a marriage partner. So these are all terms that we sort of went through, but optimizing terms does not optimize for the best relationship. The most important thing is the person. So you want to get a quality person, and you want to get somebody where there's a mutual long-term fit. And they might not have the terms. They might not have the best terms on the market. In fact, they probably won't, because there's probably a premium to work with them. And so that is the most important term is actually not a term. It's the person and the fund. You want to find a person that you trust and you want to work with. You want to have a fund that has the resources to help build you out. Having said all of that, I think the range that I've seen is between most funds will need to own between most super angel funds, which are funds that write $250,000 to $1 million checks, want to own between 10 to 20% of a company. And so, it's not uncommon. It depends on the stage, but for if it's just a market and a team with no traction, you can probably. I think it's not. It really depends. I've seen the range, but most companies for a Series Seed range will be wanting to raise like $500,000, and most investors will want at least. You can go as low as 10% for like phenomenal companies. You'll get checks for like $500,000 in the form of a note capped at $5 million, which is effectively a 10% range. But I think the more norm is like 1.5 for a 1.5 pre. So this is not really answering your question, but typically I would expect to dilute between 10 to 35% for each round. And you would probably raise at least $500,000 for the first round to like $2 to $6 million for the next round. It's all a range. Yeah. I mean, if you look at Fred Wilson. Fred Wilson, he invested in Twitter, and he took I think 10%, and most of the investors weren't willing to take that little. Okay, but he had faith in the company and he had faith in the guys, and that's an example of the marginal. I mean, he's a phenomenal person too, right? So they got a fantastic investor, and they got an investor who took less ownership than most of the investors at the time would have taken. Okay, I mean, so there are extremes, and I don't know if there is. I don't think there is a textbook average valuation these days. I think it just depends on the company and it depends on who you're pitching. Okay. There was in the old. There was like what's the pre-money valuation going for these days for software companies?
There was a book published on this kind of stuff in like '99, and it's like
you can still see those reports. There are reports on what the average valuations are.
Right, but they're ancient.
So should we do a quick? I just pummeled you guys with like a lecture. Vlad, do you have a question? Yeah, Gertz.
Are things different if the company gets acquired as opposed to go public?
Are things different if the company gets acquired as opposed to go public?
Watch out for, look out for.
What are the things to look out for if you get acquired versus go public? That's when you really want to look for the change of control provisions. So the double trigger versus single trigger. The liquidation preferences matter a lot more because your shares haven't converted to common. So those all kick in. Those are probably the most important things to look out for. There's a bunch of provisions that get put in there around the whole going public process that don't apply when you get acquired. But those are probably the more material ones. The change of control, especially if you get acquired before you vest, that's the most important thing. Yeah?
I also remember reading something about repurchase rights based on the fair market value of the stock. How dangerous those things?
So the question was around repurchase rights based on the fair market value of the stock. I'm not sure if that's referring to one of a few things. There are provisions where the VC will say that the company has to repurchase their. Is that what you're referring to? Yeah. So sometimes the VCs will put in a provision saying that if the company has, and this is to prevent a living dead or a situation where it's an ongoing business that is just a good business that's never going to go public, that's not going to die, but it's just a good business. And most of these venture funds have 10-year lives. So they have the ability to commit their capital for 10 years before they really need it back or have liquidity. If you're in a situation where you have a company that's 10 years out and it's still just chugging along, but it's not going to go public, but you also don't want to sell it, they have the repurchase right is intended to give the company the ability to buy back the shares from the VC at the VC's discretion, with usually provisions around interest and dividends. And I don't think, I mean, it might be dangerous. I haven't seen it. I haven't seen a situation. That doesn't mean that one hasn't existed, but I haven't seen that hurt somebody. Okay. That was a lot. We have a few things, actually, that were left. The first thing was that Helen wanted to get testimonials. Well, so I needed to do a few polling things. Well, so we can do a few different things. One is we can have like a little meeting on where everybody's at with their ventures, like a check-in. Are people exhausted to do that, or do you want to do that?
Tell me about yourself.
That's a broad question. Hi, all right, so my name is Jay, and I'm a first-time entrepreneur. I just moved here to Silicon Valley from San Diego to bootstrap a startup. And I'm building a marketplace to connect people who need computer repair directly with individuals locally who can provide computer repair.
Okay. Why did you take this course?
I took this course because I realized that I come from a technical background. I have a bachelor's in computer science, and I don't have a lot of experience with company building, and I know that there's a lot of things that I don't know. And so coming here for this course, I learned a lot of the business side of things, especially sales, marketing, all the stuff that I'm missing in company building.
Okay. Would you recommend this course to your friends?
I would highly recommend this course to my friends.
Why? Or what did you get out of it?
Like I said, it's all the stuff that, if you're coming from a technical background, it's all the business side of things, that the company building side of things, the legalities, the fundraising tactics, tricks, all, negotiation stuff that you're probably weak on. And so this course really helps make you feel more adequate in that department.
Okay, and God, I don't remember. How much did you tell me about your background? Like, where did you go to school?
I went to school I went to college at the University of Louisiana at Monroe.
And majored in?
Majored in computer science. BS computer science with a minor in math.
Okay. Is there anything else you want to add?
So being an outsider to Silicon Valley, coming here, I feel like coming to this course and meeting all the people around here through Ravi has really helped me feel more settled in the Silicon Valley culture. So I highly recommend it, and I love it.